Good evening, ladies and gentlemen. It's time for another exciting adventure of stocks and bonds with Giorgio and Michele. Last week was video 1 and this week is video 2. And I'm going to start the program here by asking Giorgio a follow-up question from last week's discussion. Last week, I suggested that in the middle of November, the stock market went up tremendously because of I will actually just, Giorgio, why did it go up so tremendously? And I think he thought I meant November of 2022, but I was specifically referring to the week of November, the middle of November of 2023, in when stock prices jumped 8 to 10%. And of course, bond rates went down. So Giorgio, my thought on this, you mentioned that there was liquidity in the system that drove it higher, maybe for the whole 12 months, starting in November 2022. But now I'm talking about the jump in prices in mid-November of 2023. And my point is, I think it's all because the market had a change in sentiment. I think when the GDP came out at 4.9%, which is now 5.2%, and also that the personal consumption expenditures index went down, actually it was the consumer price index went down. I think the market moved from higher for longer to a sentiment of soft landing, and that's what pushed the market higher. What do you think?
Well, a famous, well-known TV business channel said, I don't remember the exact line, but it said like market soars on hope of Fed pivot. And that caught my attention because it's total nonsense. And, it just blows my mind how whenever people don't know what to say, they say the Fed. No one really talks about the reasons why interest rates come down, why commodities come down. No one, always the Fed. No one says that, it's business that is doing certain, moves in a certain direction, is businessmen trying to react to poor earnings or at least rising cost. It's always everything happens because of the Fed. And by the way, if there is something that is beginning to happen, I'm in the camp that the Fed doesn't count, okay? Which new Argentinian president, they want to eliminate the Fed. They should not, because they need a regulator of the banking system. But that's about it. The fact of the matter is that banks are slowing down tremendously, credit and loans. And now, year over year, zero or negative. What does it mean? That the banking system are not lending because they see trouble ahead. And I just updated the data for, now in a production to write the next issue that is going to be available on our website and on next Sunday, the 10th. And all the data point down. So with the economy weakening, you should expect interest rates to decline, commodities to decline, the economy to weaken, and interest rates to decline, and the bond rate to rise. Now, you're talking about the stock market. That's
it. That's the difference. The difference between what the economy is doing and what the stock market is doing.
That is very true. The fact is, the stock market, there is liquidity in the system. There is, and the reason I know that is that the credit spreads between bonds, corporate bonds, and treasuries are low, no resemblance of going up. So everything is negative, but somehow in the system feels comfortable.
You mean stock investors feel comfortable in investing?
Right. Because usually you should have to have a major peak in the market, or a major decline, let's call it peak, because the market doesn't do anything since 2021. It actually is below those levels. in order for the market to go down, it takes, one of the things that it takes is spreads to rise, and the spreads are not rising. They are very low. And this tells you that the financial system is comfortable, despite Jamie Dimon saying and repeating, be careful, there is a problem out there.
Could it have anything to do with the fact that people talk about the markets look 6 months ahead, and 6 months from now, they're thinking the Fed's going to stop, in fact, starting to lower rates 6 months ahead.
The
So
Fed
let's get
doesn't
in on
lower-
the thing now.
But you see, that the Fed doesn't lower rates, the markets do. The interest rates have been coming down now for already several weeks. Big
But
time.
all the headlines are what the Fed is going to do.
But that's wrong. That's my point. There are only two people. I'm beginning to see other people saying the same thing, and that's why I mentioned the president of Argentina, because in the camp that the Fed, but even Bernanke said it years ago, the Fed is a big megaphone.
Greenspan.
Greenspan. It's not. How can you think that raising or lowering interest rates 25 basis points, you move a 25 trillion plus
The
economy?
market seems to think so. The market
No,
jumps to that.
are the banks. The fact that the banks see trouble ahead, by the way, are the banks that print money, not the Fed. That's to make clear about that. The fact that the money supply M2, in fact, I have a chart if you want to see it, but no one is bored to look at it because those are hard facts, is the money supply is contracting. Now, people say, well, time is different, the money doesn't count. It's always like that, right? When something is out of the charts, say that doesn't count. However, and again, I have the data to show it to you. If you go, Milton Friedman said, if the money supply grows at 3 to 6%, everything is okay. You go above that range, you got inflation. This is what happened in the 70s, and this is what has happened in the last 2 or 3 years. In between, the money supply M2 was growing at 3 to 6%, and you had 0 to 2% inflation. Now you have money supply contracting at 3-4% over 12 months for a long time. But this doesn't matter. I mean, if is inflationary above 3 and 6, if it is no inflation between 0 and 3, and now you see contracting the way it does, it has to be bad times ahead. It doesn't matter what the government does. Now, let me tell you what the government is doing. And let's just check the data, which is the only positive economic piece of information.
Spending like a drunken sailor.
Construction is up 7% year over year after inflation. So they're spending at a rate, and that's even as of Q4, the government is spending faster than GDP growth. That's where the strength of the market. Okay, this is the growth of the money supply. You know, as I said, there is some strength in the economy, and it's going at 1.5 to 2%, and it's slowing down. All the data are coming down. There's no question about it. Durable goods orders, unemployment claims, leading indicators. I mean, everything says the economy is to slow down. But what is the important thing is this chart. And this chart shows the money supply from the 70s to now. Now, Milton Friedman said, when the money supply, I cannot do this. When the money supply grows between 0 and 3%, 6%, that's in this neighborhood here, then inflation is between 0 and 2%. When the money supply, like here, grows above 6% or here, then you have a bout of inflation. So now money supply has been contracting for a long time. And you've never seen this in the last 100 years. Now, of course, people say, well, this doesn't matter. Yeah, this doesn't matter, but it matters for the last 60 years that what we had, of course, is variable, is volatile. But this is really a contraction in the money supply. Now, why we have this? Because money is printed by banks. And banks are not lending. Why are not lending? Because they don't see opportunity, they see risk. When the housing market is weak and prices are coming down, the commercial bank, the real estate is having problem. Consumers are borrowing up to the eyeballs. Obviously, banks are not lending. So they're not printing. When you don't lend money, you don't print money. So is this a positive? No, it cannot be a positive. And this is what, when there is no money, you have to pay the consequences. What are the consequences? Much slower economic growth. And why? But economic growth, what does it mean? It means that business people are retrenching. They are cutting inventories. They are maybe cutting prices to sell more. They're cutting borrowing because now they don't need to produce as much. You have capital investments are declining, so you don't borrow as much long-term. That's why long-term interest rates are declining. So all these business decisions, as a result, that the economy caused the economy to slow down. And what the money supply is saying is the banks are so worried that really that number points more to deflations in a serious economic setback that people think.
Well,
Now,
when is this going to hit the stock market? It's not now.
This, as I told you before last week, the stock market has not done anything since 2021. It's below the levels of 2021. If you look at the small caps, they're not doing anything for the last 12 months. So it's just the famous, some tech companies that are carrying the ball. But really, the market has not done anything since 2021.
The stocks that I follow, the industrials specifically, have gone up tremendously in the last month. What can I say? I'm experiencing 8 to 10% up.
I know, but you cannot make a point of more money supply or monetary policy or strategic decision based on 1 month. The market went 1 month, but it's still below what it was in September. If you look at the performance between September, I just did it, between September and the end of November, for those 2 months, the only stocks that really went up are technology and commercial communication services. All the others are either flat or down. You know, you talk quote unquote the market. Sure, if you're nitpicking, there's always a stock that's up 200, 300%. When we talk the broad market, which means we are talking the economy, the market is not doing much at all. In the last 2 years, you outperformed the market handsomely by investing in cash, which is typical of high inflationary times. The reason I was #1 in the 80s among all the investment advisors, and I didn't sell one subscription, because I was always in cash. And Forbes put me always on top of the best 5, because I was in cash. So it, 1 week or 1 month doesn't mean anything.
You brought up a chart last week, and it was at the end of the program, and I asked you to explain the squiggles on the right-hand side of the chart. Do you remember that? It was the business, your business cycle chart. And you were talking about perhaps it's the start or the end of another business cycle, right in the last 3 or 4 months of your chart, the squiggles. Do you have that chart? And can you just address those squiggles?
But anyway, the green one is the business cycle as I compute from the data.
Now, see, from October through November, how much it rose?
Oh, yeah, no question about it.
Yeah, well, you got to explain that because you keep saying it's going down.
No, I didn't say that. I said going down. I had.
You say it's got to be bad.
Let's go with it. So I don't have to explain it again. Let me drink a glass of wine. I got some. My tongue moves better when I drink wine.
Looks to me like it's on a rise.
Well, let's go with it.
You ready?
Right. How do we go?
All right, Giorgio, this is what a similar slide to what you showed last week. at the end of the program, and I questioned you about those last 3 or 4 or 5 months, where although it was going down, it started to turn around at the beginning of November. See that? From the 3.2 to the 3.55. How do you explain that?
Absolutely. I love to explain things. First of all, the chart at the top back is the growth of the change over 12 months in the stock market. Okay.
Well, look at that change. Holy cow.
That's what I say. And then the bottom chart instead is the business cycle as I computed from strictly market data. And the reason this is useful, because when the trend is up, like for instance from 216 to 218, or from 2020 to 2021, or from 2012 to 2014, the economy is strengthening, and then growth stocks are outperform the market. Cyclical stocks outperform the market. When this curve declines, like from 2014 to 16, 2018 to 2020, and from 2021 to 2022, then instead the defensive stocks outperform, including bonds. What made something very interesting 2022, and again, I was, by the way, one of the first one mentioning this, according to one of my listeners. 2022 made a lot of people, including myself, wrong, because during this time, 2022 to 2023, the economy was weakening and bonds should have been strong. Instead, they took a beating of a lifetime, which is really, since it's more than a lifetime that this has happened. So 2022 was a very special year. Now, what happened?
Was raising rates.
That is definitely the reason. Then on 2022, yeah, but remember that people like Guggenheim and BlackRock, global investment strategies that manage trillions of dollars, they were wrong too. Because they thought with the economy slow down, other things happen. But anyway, it didn't. We were wrong. That's fine. Let's move on. On 2022, then I noticed in my tweets and that there was some liquidity going up. And actually, I was one of the first one noticing that. And now the 2022, this thing, my business cycle started going up. Now, is this the beginning of a business cycle, new business cycle? Probably so. But I don't follow it. I don't believe it. So I'm fighting what the evidence says. Why? Because in the last data show that consumer spending on durable goods, capital investments, which are durable goods, and the orders for durable goods, they have been declining for some time after inflation. And that's not what happens during a business cycle, at the beginning of a business cycle. During the beginning of a business cycle, you don't see the leading indicators contracting, you don't see all sorts of things, housing going down, you don't see all that. So as 22 was an aberration, probably what is happening in 2023 is another aberration.
Another aberration.
I know, but that is a fact. It's a fact.
You can also see this in the Shiller PE ratio. The Shiller PE ratio.
Yeah, but that's not a
They're
good.
so high. It's just so above average.
Has been proven, the Shiller is not a timing, market timing, not a timing indicator.
It's pointing out the fact that the market is highly overvalued.
However, what I think is happening, that slowly we are moving into what has happened prior to 2022. That's my current strategy. In several markets, it looks like are proving me right. What happens during a period when this curve declines, the business cycle declines, you should see interest rates declining. They are. You should see commodities declining. They are. You should see inflation declining. It is. You should see durable goods orders and everything going down. They are. You should see claims, continued claims rising. They are. You see leading indicators contracting. They are. So I had the feeling that, and again, strategy means you play the odds. By the way, there is another market that is also strong, which I've been saying, watch it, and it's happening, is gold. Gold finally gold is breaking up above 2,000, which seems to support the idea that now things are normalizing. Maybe the government spending on construction, which is going up, as I told you, maybe is fading away. So my current strategy is with some increasing probability that we are heading into a business cycle that was what happened prior to 22, not what happened during 22, meaning that the strategy is defensive, not aggressive. In some sectors like bonds and gold are likely to keep on outperforming, as they did, by the way, in the last couple of months. So that's how I read the current business cycle. I know I gave a lot.
With that, we're about running out of time. So whether you have anything further you'd like to add to this discussion for today?
No, but I think people should subscribe to this channel by clicking subscribe under the video. And we would appreciate it very much if they visit our website, www.peterdag.com.